Hello, hello. Welcome to Tax Roadmap. I am Nafisa Manera, your tax attorney and CPA who rescues businesses and individuals from tax debts and trains the next generation of attorneys and CPAs to do the same. Again, welcome today to our channel, and we want to make sure that we get started. Go ahead and like and subscribe my channel so you can be alerted every time I'm dropping new gems, every time I'm dropping the next tax updates and latest tax news, every time I'm dropping it, you can be alerted. Yes, we're going to jump right in it today. And today's title of Tax Roadmap is All of Your Clients' Income is Taxed by the IRS, except all of your client's income is taxed by the IRS, except, and we're going to highlight maybe 10 of those exceptions. So always remember, right? Particularly if you're new, and sometimes even as experienced practitioners, we have to get back to the basics. But particularly if you're new, always remember that all income, no matter where your client makes it anywhere in the world, is going to be taxed by the IRS unless it's specifically excluded. There's a specific exemption or exclusion for it. Okay. So always remember that as a basis. So today we're going to talk about just 10 of the different types of income that is not taxed by the IRS, that is excluded. Okay. So let's jump right in and get started. Okay. So the number one is going to be life insurance payouts. So if your client has received, maybe their parents passed away, right? And they were the beneficiary of their parents' life insurance policy, then those proceeds to your client as the beneficiary, they're going to be tax free. That's not going to be taxable. So if it's 250,000, a million, $20,000, whatever those life insurance proceeds are, they're not going to be taxable as income by the IRS. Number two, we kind of talked a little bit about this last week, was gifts. Any gifts that you receive, they're not going to be taxable. Okay. Now, they're not going to be taxable to your client as the receiver, as the donee, as the recipient of the gift. But if those gifts are more than a certain amount, they may be taxable to the giver, to the donor, to the person who's donating the particular gift. But if your client is the donee, those gifts are not going to be taxable. Okay. Third thing is scholarships and grants for education. Those are not going to be taxable. Now, they're not going to be taxable if they're used for educational purposes and specifically tuition and fees. Now, when it comes to room and board, it's going to be taxable. So, for example, if your client's client, or if your client, for example, receives a tax, receives a scholarship, for example, let's say for $50,000, okay, and it costs 30,000. This is maybe for law school. Costs 30,000 to go to this particular law school, right? The other 20,000 they use for room and board. Well, the 30,000 is not going to be taxable because they use that for tuition to pay for their law school, right? But the 20,000 will be taxable because they use that for room and board. So just keep that in mind. But the amount that is used for tuition and fees, that's not going to be taxable by the IRS. Okay, and it's usually excluded for state purposes as well. The fourth one is inheritance tax. I'm sorry, inheritance. So any type of inheritance that your client receives, okay, whether you're talking about cash, stocks, bonds, property, it's not going to be taxable as inheritance. Now, remember last week we talked about the estate tax. Now, the estate of whoever that person that died, the estate of that person may have to have taxed, right? So if you look at all, let's say their granddad died and all of they're the beneficiary, or they're inheriting everything from their granddad. Well, first, a lot of those assets has to go into the bucket of the estate. And if it's more than, as we just said last week, if it's more than $13 million, right, then it's going to be subject to tax at the estate level. But once it comes out of the bucket and it's distributed to the beneficiaries, to those who inherit that inherit that stock or inherit that property, then it will not be taxed to that particular person. So keep that in mind, that that is a distinction, right? And depending on the clients that you're dealing with, this particular market of clients that you're dealing with, if you're dealing with very high net worth individuals, for example, I don't have a lot of high net worth, and high net worth is usually considered with a net worth of $10 million or more. I don't deal with a lot of high net worth clients, but I do have some high net worth clients, right? Particularly because they own a lot of real estate. And real estate, their house, or they own 2 or 3 houses, could be valued at way over 10 million, right? Way over 13 million, right? I have a client who has a house here in Atlanta that's valued at 11 million, and he has a house in another state that's valued at 5 million, right? So that's $16 million just in property alone, not including all his other assets, right? So it could be the case, depending on what the liabilities are on those properties, that that 16 million is more than that 13 million, and so that his estate would be subject to estate tax. But when those properties, the one that he owns here in Atlanta, the one he owns in someplace else, are distributed to, let's say, for example, his daughters, they will not have to pay inheritance tax. Okay. So, all right. Now, the other tax is called municipal bond interest. Now, remember that municipal bonds are basically a security at the local or state level. So, if, for example, we're here in Atlanta, Georgia, right? So, if the city of Atlanta issues bonds, right, and those bonds pay interest, right, then that interest is going to be excluded for federal tax purposes and for state tax purposes. Okay, so that interest is going to be excluded for federal tax purposes and state tax purposes. And remember, bonds are usually issued, again, by the city or the county to cover different costs, whether it's to cover the parks. We have a lot of green space initiatives down here in Georgia. So a lot of times they issue bonds to cover different parks and green space initiatives. They issue bonds to cover housing, different types of initiatives that a city or county or state may have, but the interest that is paid to you as the bondholder, as the one who invested in those bonds, is going to be tax-free. Okay, you will not be taxable by the IRS. Another thing is the withdrawals from health savings accounts, right? The withdrawals from health savings account, HSAs. Some people set up HSAs as business owners, as employees. It really depends, right? To be able to pay their medical expenses, their health related expenses out of that. Well, anytime they withdraw that money, they're not going to be taxed on that. Okay, that is going to be tax free. The other thing that's kind of popular, a lot of times I might get questions asked, there's a lot of confusion about, is child support payments. Child support payments that someone receives are not taxable. They're not deductible either by the person that paid them. Okay, so if your client is the one who pays the child support payments, the child support payments are not going to be deductible by your client as an expense. Okay. And if your client is the one who is receiving child support, those are not going to be included in their income. And even if you are outsourcing um, someone that's doing the actual tax returns, when you are looking through the financial analysis of your client to try to determine how to resolve their tax debt, these are the income sources that they may give you, and you need to determine whether it's included or not. Okay. Also, the number 8 thing is military combat payments. So if you have a client that served, maybe they had they served like 2 years or whatever in the military. It's been 2 years ago, and they haven't filed those tax returns, right? Well, any income that they earned while they were serving in a combat zone is not going to be taxable, as well as contractors who are in these combat zones who are assisting the military. So these military contractors, a lot of their income is not going to be taxable either because they're serving in the combat zone assisting the military. Okay. And there's like maybe 3 or 4 different combat zones, like Afghanistan, what they call the Sinai Peninsula. You got the Arabia Peninsula, and I think Kosovo, right? So a lot of that stuff that's going on in the Middle East, right? Afghanistan, Albania, those are designated combat zones. And people who work in those areas, whether you're military or a contractor for the military, are not gonna, that income is not gonna be taxable. Okay. And then there are lawsuits, right? Lawsuit settlements. You hear people getting lawsuit settlements. They won a personal injury lawsuit, they run a civil suit, that type of thing. Well, a lot of times that money that they receive is not going to be taxable. Now, it's not going to be taxable. It depends on how it's classified. If it's classified as they got that settlement because of lost wages, right? They should have been paid a certain amount of wages and they weren't. So this is wages, then that will be taxable. If it's punitive damages, they're trying to punish a particular company or whatever, those sometimes will be taxable. But if it's a personal injury, unless they're getting money because they lost a limb or they were sick and they're being compensated in that way, those monies will not be taxable to your client. Okay. And then the last one is going to be any type of Roth IRA withdrawals. We know that anytime we withdraw from a traditional IRA, that's going to be taxable. Okay. But if your client is taking Roth IRA withdrawals, those are not going to be taxable. So just keep those in mind. Those are not all the income that's excluded from being taxed by the IRS, but those were kind of like the most common ones that usually come up. And just keep those in mind as you are doing the financial analysis on your client. You want to make sure that when you're looking at this type of income, you're able to immediately identify it and know that it is excluded from being taxable. Okay. Understand that is excluded from being taxable. So you want to make sure that you take that in consideration. And when you're reviewing their tax returns or you're reviewing the information that they submitted to you, that you take that in consideration, right? So I hope this was some help for you, particularly you new people who are new to this space, tax representation, tax controversy space. Again, thank you for joining me today, Nafisa Munir on Tax Roadmap. I hope to see you next time. Make sure you like and subscribe my channel. And if you want to know more or you have any questions, contact me. I'll be glad to help you. Have a wonderful day. Bye.